Something very strange just happened in the silver market. In fact, strange is the polite word. A more accurate word would be engineered. Silver didn't just fall, it didn't correct, it didn't react to news. It was forced down violently in a way we have seen before again and again for over 4 decades. And yet, if you turn on mainstream financial media, you're being told a neat little story, a comfortable story, a story that fits nicely into a headline and makes everyone feel safe. But that story is missing the most important part. Today, I want to walk you through what really happened, who benefited, and why this crash may have changed the silver market permanently. This is not hype, this is not panic, and this is definitely not financial advice. This is pattern recognition. Before we continue, if you're getting value from this video, make sure to hit the subscribe button and turn on notifications so you don't miss upcoming updates. And if you have any questions about the markets, silver, or anything you'd like to ask, leave them in the comments. I read every single one, and I'll be answering your questions in the next video. Also, let me know where you're watching from and what time it is there right now. I love seeing how global this community is. I'll catch you in the next one. According to the official narrative, silver collapsed because of macro news. A new Federal Reserve Chair nominee, a stronger dollar, concerns about tighter monetary policy, risk-off sentiment. Sounds reasonable, right? Except it doesn't explain the speed, the timing, or the mechanics of the crash. Markets don't usually lose over 30% in a matter of hours because of a press headline. They lose that way when forced liquidation is triggered. And forced liquidation doesn't come from fear alone. It comes from structure. Let's get one thing clear. Not all crashes are the same. In a normal market drop, investors take profits, sentiment shifts gradually, and buyers and sellers negotiate price. In a liquidation event, leverage gets squeezed, margin calls force selling, stop losses cascade, and algorithms dump positions automatically. This silver crash was not a normal market move. It had all the fingerprints of a liquidation cascade. And liquidation cascades don't just happen, they are triggered. To understand this, you need to understand how the paper silver market works. Most silver trading does not involve physical metal. It happens through futures contracts. When traders buy silver futures, they don't pay full price. They post margin, often 10% or less of the contract value. That means leverage amplifies gains, but leverage also amplifies losses. Now here's the critical part. The exchange can change margin requirements at any time. No vote, no warning, no debate, just a rule change. When margin requirements rise suddenly, traders have only 2 options. They either add more capital immediately or they sell their position. Most leveraged traders are already fully margined. So when margins jump sharply, they can't add cash. They are forced to sell. That selling pushes prices down. Lower prices trigger more margin calls, which forces more selling. This is how a controlled demolition happens. Now notice something interesting. These events often happen on Fridays during thin liquidity, when Asian markets are closed and when reaction time is minimal. That's not coincidence. Thin markets magnify price moves, and the people who run the system know exactly where leverage is concentrated. So ask yourself a simple question. Who was under pressure before the crash? It wasn't retail investors. It wasn't miners. It wasn't physical silver holders. It was commercial shorts. Large institutions that had been betting against silver were getting squeezed as prices climbed. A forced liquidation flushes out leveraged longs, resets sentiment, and allows shorts to cover at lower prices. This is not a conspiracy theory. It's how derivatives markets function. Here's where most people get confused. They assume that if silver crashes, demand must be gone. But paper price and physical reality are not the same thing. The paper market can be distorted by leverage. The physical market cannot. You cannot margin call a silver bar. You cannot algorithmically liquidate a coin. And that's why something very interesting happened after the crash. Let's look at fundamentals. This crash did not create new silver supply. It did not reduce industrial demand. It did not eliminate deficits. It did not change usage in solar, electric vehicles, or data centers. We are still facing multi-year supply deficits. Industrial demand is structural, not speculative. Silver isn't just money anymore. It's a strategic metal. You can smash the paper price, but you cannot print atoms. Here's the irony. By raising margins aggressively, the system may have driven retail traders out of paper silver, discouraged participation in futures markets, and weakened confidence in paper pricing. In other words, the paper market may be eating itself. And when paper loses credibility, attention shifts to physical settlement. That's when shortages become visible. We've seen this playbook before. In 1980, Rule changes crushed silver. In 2011, margin hikes killed the rally. In recent years, thin liquidity flushes did the same thing. Every time, the method was identical. Leverage allowed the rise, and rule changes forced the fall. The difference now is that industrial demand didn't exist at this scale back then. After liquidation events, markets typically do one of two things. They either drift sideways as leverage resets, or they recover sharply once forced selling ends. What matters is whether fundamentals changed. In this case, they didn't, which means price discovery hasn't finished yet. Retail traders usually lose money not because they're wrong, but because they're over-leveraged. Leverage turns volatility into destruction. The market doesn't need to beat you, it just needs to shake you out, and that's exactly what liquidation events are designed to do. This silver crash was not random. It was not purely news-driven. It did not fix supply issues, but it did reset leverage. Whether it becomes a historic opportunity or a warning depends on time horizon and position sizing. Paper markets are fragile, physical realities are not. If you've been in markets for any length of time, you probably felt it immediately. This crash didn't just hurt portfolios, it shocked confidence. And that's because silver wasn't some forgotten corner of the market anymore. It had become a crowded trade. Retail traders were in it, hedge funds were in it, momentum traders, ETFs, algorithmic strategies. Everyone was on the same side. And when everyone is on the same side of the boat doesn't gently tilt, it capsizes. Crowded trades don't unwind politely, they unwind violently. That's exactly what liquidation events are built to exploit. You'll hear a lot of people say silver fell because the dollar strengthened. And that's not entirely wrong, but it's incomplete. Yes, commodities are priced in dollars, and yes, a stronger dollar puts pressure on prices. But the dollar didn't move nearly enough to justify the scale of this collapse. The dollar was the match, leverage was the fuel, and margin hikes were the detonator. Without leverage, dollar moves create volatility. With leverage, they create destruction. Modern markets are no longer human. They're automated. Algorithms don't ask whether silver is undervalued or whether demand is still strong. They don't ask whether a move makes sense. They ask whether a level broke, whether a stop was triggered, whether volatility is expanding. Once selling begins, algorithms accelerate it. They don't care why something is happening. They only care that it is happening. That's why crashes today feel faster and more brutal than ever before. While most people were staring at price charts, something else was happening quietly in the background. Physical premiums didn't collapse the way paper prices did. In some regions, they stayed elevated. In others, they widened. That's a warning sign. Because when paper prices collapse but physical prices don't follow proportionally, it tells you something important. The paper price is lying. Paper markets can reset instantly. Physical markets cannot. A futures contract can be liquidated in seconds. A warehouse cannot. A leveraged ETF can go to zero. A solar manufacturer still needs silver. A paper price can crash in hours. But a mine cannot suddenly double output overnight. This is why paper and physical prices eventually diverge during periods of stress. And when they diverge long enough, credibility breaks. People love analogies, but lazy analogies are dangerous. Yes, margin hikes happened in 1980. Yes, they happened again in 2011. But the context today is completely different. Back then, silver demand was mostly speculative. Industrial usage was limited. Substitution wasn't urgent. Today, silver is critical to modern infrastructure. Energy systems, electric vehicles, artificial intelligence, and data centers all depend on it. Governments want electrification, and they want it fast. That changes everything. Silver is not rare, but it is constrained. Most silver is produced as a byproduct of other mining operations. Its supply depends on copper, lead, and zinc mining. Even if silver prices double, mines don't instantly double output. Permitting takes years. Infrastructure takes time. Supply is inelastic, and that becomes a serious problem when demand keeps rising. Here's the uncomfortable truth. If silver remains strategically important and paper markets remain heavily leveraged, then volatility is not going away. Sharp rallies, violent crashes, repeated flushes, emotional whiplash, this is what a stressed system looks like. Smooth markets only exist when supply and demand are balanced. Imbalanced systems swing. After crashes like this, people usually fall into one of two traps. Some panic and sell at the worst possible moment because fear peaks after the damage is already done. Others cling to blind hope, ignoring risk, leverage, and position size because they believe prices must recover quickly. Neither approach is intelligent. Survival in volatile markets isn't about emotion, it's about structure. This cannot be said enough. Leverage is not evil, but it is unforgiving. In manipulated or illiquid markets, leverage turns normal volatility into financial ruin. The system doesn't need to guess where you'll break. It already knows. That's why leverage is always targeted first during stress events. Ironically, the harder paper markets are squeezed, the more attention shifts toward physical ownership and delivery risk. Every forced liquidation teaches participants the same lesson. If you don't own it outright, you don't really own it. That realization spreads slowly, and then all at once. Notice what happened during the crash. Silver fell harder, gold fell less. That's because silver is more industrial, more volatile, and more heavily leveraged. Gold behaves more like insurance. Silver behaves like a mix of speculation and necessity. That makes silver more explosive, both on the way up and on the way down. Instead of watching headlines, watch structure. Pay attention to margin changes, delivery volumes, physical premiums, ETF flows, and open interest. These signals matter more than narratives. Narratives explain the past, structure shapes the future. Mainstream financial media will always miss this because it struggles with mechanics. It prefers stories, personalities, and sound bites. But real market moves are driven by leverage, plumbing, rules, and incentives. That isn't dramatic, but it is decisive. Markets are not designed to be fair. They are designed to transfer risk, punish impatience, and reward structure. Understanding that doesn't make you cynical. It makes you realistic. Zoom out for a moment. This silver crash isn't just about silver. It's about fragile paper systems, leverage-dependent markets, rule-based power, and the growing tension between real assets and financial abstractions. What we're watching isn't noise. It's stress fractures forming across the system. So if you remember only one thing, remember this. Price is what trades. Value is what remains. Volatility shakes out the weak. Structure protects the prepared. And the biggest mistakes are usually made after the panic, not before it. Stay rational. Stay sized correctly. And don't confuse noise with truth. There is one more layer to this story that almost nobody talks about, and it's probably the most important one. It's not about silver specifically. It's about how modern markets are engineered to look liquid, stable, and efficient right up until the moment they aren't. Liquidity today is mostly an illusion. It exists only as long as confidence exists. The moment confidence breaks, liquidity vanishes, spreads explode, and prices gap violently. What you witnessed in silver was not just a price move, it was a liquidity event. For years, markets have been trained to believe that someone will always step in. A central bank, an exchange, a market maker, a stabilizing force. That belief creates complacency. Traders increase leverage. Risk models assume orderly exits. Stop losses are placed tightly. Everyone believes they can get out when they want. But liquidation events expose the truth. You can get out only when someone is willing to take the other side. And when everyone needs to sell at the same time, there is no other side. This is why these crashes feel unfair. People say the market is rigged, but the reality is simpler and harsher. The rules were always there. Leverage magnifies everything, including mistakes. When markets are calm, leverage feels like intelligence. When markets turn, it becomes a trap, and the trap closes very quickly. Another thing most people underestimate is how psychological these events are. Once prices start collapsing, logic disappears. People stop thinking in probabilities and start thinking in pain. They don't ask whether the fundamentals changed. They ask how to stop the bleeding. And in that moment, forced selling becomes voluntary selling. Fear takes over from structure, and that's when prices overshoot to the downside. This is also why bottoms are never obvious in real time. When prices are falling fastest, it feels irresponsible to even think about opportunity. Every headline reinforces fear. Every chart looks broken, and every commentator suddenly becomes a risk expert. That emotional environment is not accidental. It's part of the process. The market needs disbelief at the bottom just as much as it needs euphoria at the top. What makes silver particularly dangerous and fascinating at the same time is that it sits at the intersection of two worlds. It is both a monetary metal and an industrial input. That means it inherits the volatility of speculation and the rigidity of real-world demand. When investors flee, price collapses. But when manufacturers need supply, demand doesn't care about sentiment. This tension is why silver never behaves politely for long. Over the long term, markets are voting machines. Over the short term, They are weapons. The short-term price of silver is shaped by leverage, flows, and rules. The long-term value of silver is shaped by physics, chemistry, and engineering. Those two forces are constantly fighting each other. And liquidation events are what happen when the financial side temporarily overwhelms the physical side. But overwhelm does not mean eliminate. You can suppress price, you cannot suppress necessity forever. Every attempt to control markets through leverage eventually runs into the same wall, reality. At some point, someone needs delivery, someone needs material, someone needs what the contract represents, not the contract itself, and that's when paper systems are tested. This is why experienced market participants focus less on predictions and more on positioning. They don't ask where price will be tomorrow. They ask whether they can survive volatility today. Survival comes first, opportunity comes second. Anyone who reverses that order eventually learns the lesson the hard way. There is also a generational shift happening that rarely gets discussed. Younger investors are far more skeptical of financial abstractions. They've lived through repeated crises, bailouts, rule changes, and narrative reversals. They are less willing to trust paper promises and more interested in tangible exposure. That shift is slow, but it matters. It changes how markets behave over time. None of this means silver must immediately explode higher. Markets don't owe anyone a rebound. What it means is that the system is under stress, and stressed systems behave erratically. Periods of calm will be followed by periods of chaos. Anyone participating without understanding that rhythm is gambling, not investing. So the real question isn't whether silver goes up tomorrow or next month. The real question is whether the structure that caused this crash has been resolved. And the honest answer is no. Leverage can be flushed, but incentives remain. Rules can be adjusted, but behavior doesn't change overnight. That means volatility is not behind us. It's part of the landscape now. If you take anything away from this entire discussion, let it be this. Markets are stories layered on top of mechanics. Most people hear the story, very few understand the mechanics. The people who understand mechanics don't need to predict headlines. They watch pressure points, they watch leverage, they watch where stress builds quietly, long before it explodes loudly. Silver didn't just crash. It revealed something. It revealed how fragile confidence is, how powerful forced selling can be, and how disconnected paper prices can become from physical reality, even if only temporarily. Those revelations matter far beyond one metal. And as always, the greatest danger is not volatility itself. The greatest danger is being unprepared for it.